I'm Marella Fernandez. Welcome to Market Call. Paul Harris on the show today, portfolio manager at Harris Douglas Asset Management. He'll be taking your questions on North American and global stocks coming up. Call us toll free at 1-855-326-6266. You can also send an email to us at marketcall@bnnbloomberg.ca. Paul Harris, good to see you. Thanks for coming in.
My pleasure.
You see a lot of volatility in the markets in the year ahead. Is that because of Donald Trump primarily?
Well, so yeah, a couple of things. I mean, I think there's the unpredictability about what he does, right? Which is, I think, the issue for stock markets, right? So, comes out on that Monday and says something about Canada, the currency collapses, the stock market goes down, all these things. So for me, it's much more about the unpredictability. But there's a couple of other things as well. Like one of the things is that the stock market is trading at a very high multiple today, right? I mean, it's closer to 22 or 23 times earnings. The other thing is that interest rates are, around 4.5, 4.6%. So it does offer an alternative to the stock market at some point in time. And so I think that those things are going to cause just volatility in the market overall. And lastly, the Fed is very unsure what they're going to do. Like they really, they were on this kind of reduction of interest rates from last year, and then all of a sudden with all these tariffs and stuff like that. Don't get me wrong, I think they're doing the right thing, but I think that we're on a path to lower rates globally, and all of a sudden one of the largest economies in the world is saying, well, maybe not, right? And I think that has a kind of an impact on the stock market, and we don't know what all these kind of things like tariffs are going to do. I mean, tariffs are basically a supply shock to the economy, but the U.S. economy was already growing quite rapidly relative to the other people. The inflation was much higher than everybody else. So it could have a different impact on that country than it has on this country. And so I think that all those things cumulatively make for more volatility. Now, saying all that, of course, volatility can be your friend. I mean, you can use volatility to kind of buy great companies that you really like. And I think that's what, as a long-term investor, that's what you should be doing.
I was going to ask you, where do you find a safe spot in all of that volatility? What sector, for example?
Well, I mean, I think, there's obviously the defensive stuff like healthcare and all these other things that, and something in Canada, something more domestic than something more international, of course, companies like that. But I think that the problem with volatility is that two things, stocks sort of, climb up by going upstairs, but they come down by elevators, right? Sort of thing. So the volatility, in my view, which is important about it, is that if you really like companies, you do your work on it, the volatility helps you buy those companies at cheaper valuations, right? So to me, it's really important to understand that you can use it to build your better portfolio for yourself and take advantage of it, as opposed to, sort of saying, and if you're a short-term player, if you're kind of a trader, those sort of things, volatility hurts you because it's very immediate, right? And so you kind of say, okay, well, I have to get out. So whereas I don't have to think about it that way, and people who are in kind of what I do don't have to think about it that way. They have to think about it as, oh, I really like this company. I can buy it now cheaper from a valuation perspective, and I can build a better portfolio maybe than I existingly have, right? So it's a great opportunity to kind of get the right companies in your portfolio, and that's what you should think about it as opposed to thinking about it as, oh, it's volatility, I got to sell everything and go to cash, right? Sort of thing. And that's a much harder decision making to do. I think it's much more difficult to get out of cash and then go back into the market once you've, sold everything. It's too difficult, I think, for most people to do.
Okay, we do have to take a quick break. We want to line up our phone calls. Paul Harris is our guest today, taking all of your questions. He's a manager at Harris Douglas Asset. We're back in a moment. Here's how to reach us. Welcome back to Market Call. We have Paul in line here to take your questions, but we want to do an email first. Dave in Toronto says this: would like to hear your guest's opinion on MDA Space. Could be a great Canadian story. They do lower orbit satellites, I guess?
That's right, yeah. So that's one of the interesting things. They also make the Canada arm, right? The robotics thing. So that's one thing. That's the other thing, which is a fantastic thing. But I guess when you think about satellites, we always think about them being sort of these big, huge things that you send massive space. But the real growth in satellites has been low orbit satellites. So you can think of Starlink, which is, Elon Musk's kind of thing and really helped out for the Ukrainians. So those things are much cheaper to put up. And I think that's where satellites are going. And I think that MDA is, one of the leaders in that because the cost structure is so much cheaper. They've got a huge backlog, and I think that you can see a lot of growth in free cash flow. It's not a company we own, but it's actually done very well over the last little while because of the dynamics of the change in the satellite business, where it used to be very expensive. Now, I think one of the problems with it is that you'll see things that are slightly lumpy because of that, right? Because you can't always send up things right away and all these other things. So people sometimes get worried about the lumpiness and when you get earnings coming out. But I think that over the long term, this is the way the satellite industry is moving. They're one of the leaders in it, and they're doing very well. So I think that it's not a company we own, but I think it's an interesting story at these levels.
All right, let's get to our phone callers. John is on the line, calling from London, Ontario. Hi, John. What's your question for Paul?
Hi, Marilla. Hello, Paul. Apple has announced they're spending $500 billion in the United States on, among other things, the build-out of data centers. So for that, you need microchips, energy, and chip coolers. On the other hand, we've got quantum computing making claims that you don't need all this energy. So I'm stuck with Constellation Energy, which did very well the last year and most of this year. What theory do you subscribe to, and should I hold on to Constellation Energy? Thanks very much.
Right. So, I think the issue is quantum computing, and I think Microsoft came out with a new chip for some of it, but it's probably a long ways away, and it has a long time before you see kind of fruits of quantum computing, right? So, on the side of the data centers, I think data centers will continue to grow simply because although companies are spending less money on capex on AI, it's happening less, quarter over quarter, I mean. But I think that there's still going to be this need to kind of, for data centers and growth in AI will continue to grow. It's just that the cost of computing is going to come down. So in Constellation Energy's case, they're still going to have to run those places and all those other things. So that's kind of a different story. The issue would be with more like something like NVIDIA or something like that, where the cost of computing is coming down. They may not need as many chips down the road as they do today, but to run those places still costs you still have to run them, right? So they're not, the existing data centers and the growth of data centers will continue. I think that, and Constellation Energy fell because of more about DeepSeek than anything else, I think, right? As opposed to the fact that, they were going to still really need of further energy growth. So I think that's one of the things. So I think that Constellation Energy, it's not a company I follow that well, but I think that's what caused it to fall. I think that'll continue to do well because there is going to be a greater need for power in these places, right? And quantum computing may change that, but it's certainly not going to change that over the next couple of years.
Got it. All right. So for the shorter term, quantum you can get in a little bit later.
Yeah.
Got it. Let's move back to our line. David is on the line today, calling from Ottawa. Hi, David.
Yes, good afternoon. Thank you for taking my call. My question is on TD Bank. As you all know, this week we're going to have earnings coming out, TD Bank on the 27th. My question is on TD Bank and banks in general. Now, do you think earnings are going to be positive this week? And with Trump 2.0, with tariffs and whatnot, do you think it's going to have a negative effect on banks? And do you think it's better to be in a TD Bank or a Royal Bank where they have a lot of exposure in the United States? Do you own TD Bank? And thank you very much and have a great day.
I think you just got 4 questions in one.
Right.
But we'll start with TD Bank.
So we do own TD Bank, and we've held it for a long time, and it's obviously doing very poorly last year. It's doing a little bit better this year. The issue with TD Bank, obviously, the lag on the stock was the fact that they had this really issue on the AML side with the U.S. and they had to pay a huge fine. So that's the first thing. That's out of the way. TD Bank has kind of changed in the last little while. New CEO, new people at the head of a lot of different areas. So I think it's an opportunity for the company to kind of, and they're forced not to do anything, which is actually in some ways a good thing, right? So they can actually really look at all their businesses, and which is they're in the process of doing right now. Look at all their businesses and see what's not giving them the right rate of returns and get rid of those businesses. That's the first thing. The second thing is that they've got this great brand in the United States on the East Coast of the United States, that TD Bank, right? And so that's fantastic, but it's really not given them the rate of return that it should have. And so I think what they have to really figure out is how do they improve the rates of return at TD Bank in the U.S. franchise. And I think the last thing is that TD Cowen, which was the deal they did to merge their investment bank, making sure that's working well with the rest of the bank and the rest of the investment banking in this country as well. So there's an opportunity, I think, for them to show that they're doing a better job, show that they are increasing technology to be on the risk management side. So there's a great opportunity if they get all those things right for the TD Bank to do well, right? It always traded at a premium to many of the Canadian banks, and I think that it can happen again. But I think it's going to be a slow process. It doesn't happen easily. I think the last question was whether it's Canada or the United States. I can't remember.
It's basically he was asking about RBC versus TD and how much exposure RBC has to the U.S., I believe.
Yeah. So TD has more exposure on the retail side. RBC has more exposure on the investment banking side. And I think investment banking, if you look at that, it should do better this year because, one, there's less regulation on the banking side coming because of Trump. Number two, I think that there's going to be more volatility, like we talked about at the beginning of the show. Volatility really helps investment banking, and there's probably going to be more M&A. And so those things should really help the capital markets side of their business. And Royal is much larger on the capital markets side than TD is. And TD is under the microscope, so they're going to have to do a lot of things and not be able to, whereas Royal has more flexibility to do other things.
They can't rock the boat for a while. Okay, so, and they are at about 85. They're down a little bit today. We're talking about TD, and they've been hovering around that. Okay, let's move on to our next caller, Rob, on the line today, calling from Calgary. Hi, Rob. What's your question for Paul?
Hi, thanks for taking my call. Just to follow up on the previous caller's question about TD and the banking sector in general, I'd be interested in hearing Paul's opinion on HSBC. I don't see much coverage about foreign-based banks on the show, so I'd like to get Paul's take if this is a buy, hold, or sell, given the current geopolitical environment. Thanks again, and have a good afternoon.
Thank you.
Right, so HSBC is really going through a very big restructuring, right? So they are getting out of kind of the investment banking business in the United States and Europe. They're becoming much more of a retail bank. I mean, they've got this. Their HSBC obviously is really grown a lot as a big franchise in Asia. And in the UK, but that's what they're known for. So I think it's going through a lot of restructuring over the next little while. The issue for me is that I think there's other banks, if you want to buy in European banks, you can buy, like Barclays or even NatWest. I think they're going to be a better bank, or in France, BNP, but I think that HSBC is really. I find the problem I have with HSBC is I'm not sure what they want to be.
Are they sure what they want to be?
Right. So this is the whole problem. Like they grew investment banking. Now they're getting rid of investment banking. It's sort of, to me, it's sort of like it's a difficult story for me to get my head around. Although they are. And one of the ways they've sold themselves always is that they're in Asia, which is the high growth area, and that's really fair. And they understand that market very well. But I just find that they just don't understand exactly what they want to be. And so in banking, I don't think there's anything wrong with being in investment banking if it's run properly, and you don't want to compete with Goldman Sachs. Right, so if you want to compete with Goldman Sachs, then you're in trouble, right? So if you want to be in investment banking and have a good investment banking franchise, there's nothing wrong with that. But I just feel that that's what I really kind of caught off by this thing. They've sold their Canadian business, which Royal bought and did well with. But I think that's what I just don't understand what they want to be, and I don't think management is going to take a long time to actually get that message across in a clear way.
Got it. Okay, we're going to take a quick break. Back with Paul Harris in a moment. Welcome back to Market Call. We are going straight to your phone calls and get your questions answered today. Paul is at the desk with us to take those questions. Brian is calling from Trenton, Ontario. Brian, hi. What's your question for Paul?
Oh, good morning. Glad to see Paul on. I've enjoyed him for years. But I have two questions before I ask him particularly about Cameco. I phoned in twice or three times in the last year and a half to your show, which I watch almost every day. And I've raised this question. And previously, I've been told by the moderator that they'll look into it, and it happened again this morning at 11:30. And that is, on this show and that show, often you have an analyst or an advisor on who has top picks. And most of us, my investment club and other people I talk to who watch your show, keep asking this question. The person comes on with top picks, and then you show the disclosure, and not one box has a check mark in it. They're all X's. And anybody watching that's going to say, wait a minute, these are his top picks, and he has absolutely no investment connections whatsoever with his top picks. I would really like to see that addressed, and I was told.
Okay, so let's, I guess we're talking top picks. I didn't know if he was talking past picks or forward-looking picks, and I haven't paid close enough attention to each line to figure out if that's true. We will look into it. The other question you had was about Cameco.
Right. So Cameco has done really well over the last little while, simply because what that other gentleman was talking about, power, right, and the idea that nuclear power is an idea.
A way forward.
Yeah, that's right. And also smaller nuclear is one of those big things, right? So, and Cameco kind of has the best asset for that, right? So I think that's what is helped the stock over the last little while, and it's come off a bit, but I think that's what's sort of going to help the company over thing, which is something we own, because I don't like owning these companies because I find that they're these kind of cyclical stories, and they tend to be kind of too up and down a lot for my liking. But I think that Cameco is in a kind of a little bit of a sweet spot here, because people are looking at this stuff, and the way we're thinking about nuclear is a 180-degree change over the last little while, right? It was something that it was a pariah for many places.
We were moving away, absolutely.
And now I think people are thinking at it more and more, and you saw that Microsoft was speaking to the opening of 3 Mile Island again on a specific part of it. So I think that there's this issue that nuclear is a way of helping deal with power that you can't get presently from renewables, et cetera, like that, especially if you're running a data center and running a lot of AI, right? So
well, we'll see if it gets lost, and now that Donald Trump is in power and wants to go back to oil and coal.
Yeah, who knows? But I mean, I think that there's a case to be made that, especially on this idea of smaller nuclear power plants, which are, I think people were always thought about these things as being massive things, were very, very expensive. And I think that if you can get that to that smaller thing, I think it would make a lot of sense, right? It does work to cover a large area, and it's not as costly to set up. And I think that's the big thing.
Got it. All right, let's move on to Jim, who is calling from Elliott Lake today. Hi, Jim.
Hi, good afternoon. Paul, just your thoughts on Eli Lilly. It's, obviously a great franchise, and it's had quite the run, be it short term 1 year, but certainly over the longer term, 3, 5, 10 years. Do we think we need to see a pullback here to get in here, maybe today, tomorrow sort of thing, or is it just the time to get in and just kind of ride it out?
Right. Well, thanks for the call, Jim. So Eli Lilly has done well over the last little while because of their obesity drugs, right? And we own a company called, well, I'm going to talk about it anyways, but so I think that the issue with, so Eli Lilly, there are only 2 people in this market. One's Novo Nordisk, which is a Danish company, and then there's Eli Lilly. And the thing with Eli Lilly relative to the other competitor is that it's a much broader based pharmaceutical company. So they have other drugs that will help them throughout the space. But this is the drug that has become a very big blockbuster for both these companies. And Eli Lilly, and there's no other, I think people get worried about the competition. There's more competition coming, don't get me wrong. But the competition, the problem with the drug industry is that once you develop it, you have to get FDA approval. If you get FDA approval, you have to manufacture it. Manufacturing drugs is, what I mean, is people think once it's approved by the FDA, you automatically start selling this stuff. You have to manufacture it. So I think that's the bigger issue for a lot of these things. So there's a big, huge timeline, and both Eli Lilly and Novo are changing the molecule as they go along. And so I think you're seeing some better results from that. And so I think it's a great company to own. I mean, I own Novo, but and I bought it for different reasons initially. But I think that Eli is a great company, and they're in a sweet spot of not only obesity, but they're also in a sweet spot of other drugs, they're much more diversified as a drug company.
So there's a lag, apparently, is what you're saying, once they get the approval by the FDA before they can actually churn it out.
Yeah, there's so you saw that with Eli Lilly and with Novo. There was a huge, because the drug there was such demand, there was a huge backlog because they couldn't produce it fast enough, right? And so, but manufacturing a drug is not an easy thing, because there's many more. It's not sort of thing. Oh, I'm making a widget, right? There's all kinds of controls in it and stuff like that, and you have to have the capacity to do that and things like that. So it does take a lot of time to bring a drug from even FDA approval to market, right? And so there are a lot of people that are working on obesity drugs, but they're kind of behind the curve in many ways because they've got to still get, I mean, I think the best one is that in maybe phase 2 trials, they still have to go to phase 3, right? So there's a long timeline before they get approved as well. So, but there's a lot of issues with these drugs. They're very costly, and I think that the U.S. government was trying to bring down pricing and all these things. But nonetheless, I mean, there's a huge franchise, and they can grow quite a bit, I think.
Got it. All right. We are going to take a quick break. When we come back, a look at our guests' past picks. That's coming up. Welcome back to the show. Time now for our guests' past picks. We have Paul Harris at the desk, and we'll take a look at the picks from December of 2023. So December 28th, 2023. We'll start with Stryker, which is trading on the New York Stock Exchange. Recommended at the time just shy of $300 US, now at $387 plus. A return of 30%, a total return of 31%. So a good investment there. Why did you like Stryker?
So Stryker is a medical device company, and so they make things like hips, knees, spines. They bought a company called Wright Medical. They does ankles and hands. And so, you know, medical devices is a really is great because they not only increase the quality of life of an individual, but they also keep people out of hospitals, right? So they're important devices to have. And if you look at Stryker, about 71% of their revenue comes from the United States, about 16% from developed world, and the rest from emerging markets. So there's a lot of growth in the company, kind of geographically. The other thing is there's a bit of an annuity because, one, if a doctor uses Stryker, they don't actually switch to another thing. I mean, you know, it's like if they're doing
loyalty.
knees, it's like that in that respect. And the last thing is that you have an aging population that really needs this sort of stuff, right? And so there was a massive backlog because of COVID, because these aren't considered, they're considered electives, right? So they all stopped. So that backlog is slowly going away. But I think Stryker has this great opportunity to, you know, really kind of grow internationally, you know, grow through acquisitions. They constantly buy a few things. And I think that they will, you know, this is a needed product as we go through this demographic where people are getting older and they really need these things. And it really it changes the quality of life, but it also changes the hospital stay. Like a knee operation, you can go in and be out in a couple of days, right? So that's the big difference between all this stuff. So I like the story. I think it has great growth over the next little while. And, you know, so I think we continue to own it and we continue to buy it here.
Okay, so they're at $389 even up today, Stryker on the New York Stock Exchange. All right, let's go to the next past pick, which was Visa. At the time, recommended at $260 US, now at $349 US. Return of 34%, total return of 35% with dividends. So Visa, it's almost like you can't go wrong with Visa.
Yeah, you know, it's
sad, but it's true.
It's a toll booth, right? So, you know, people don't, like, it's not, if you have a Visa card and it's done by TD, well, TD takes on all the risks on the card, on the delinquencies and all that stuff. Visa just gets paid every time you use the card, right? So it's a great service like that. That's one thing. It's got a lot of growth internationally because people still use a lot of cash still. So that's the thing. I think the other thing is a lot of these loyalty programs have really helped Visa and even MasterCard, right? Because people tend to use their credit cards a lot more these days than they did years ago because they want the points so they can use it for travel, et cetera. So that's really helping. You know, I think one of the issues that Visa's faced is that they are not, it's very hard for them to do a lot of acquisitions. They've gotten too big. And so that may change kind of because of deregulation on the financial side because of Trump and stuff like that. But really, they've tried to do a company called Plaid, which they weren't able to do. So I think that acquisitions have been very difficult for them. I think the other issue is that people worry about is that technology is changing very quickly and people may not need a Visa card as much. But if you look at Apple Pay or Google Pay, you put your Visa card in there.
It's still linked to your card. Yeah.
And it's really hard for them. That network that they have is so incredible that it's very hard to duplicate it, right? So, you know, there are only really three big players, Visa, well, I guess four, Visa, Visa, MasterCard, and Discovery, which is now owned by, I think they joined with somebody else, I can't remember. And then there's American Express, right? And so they control that kind of market. So you've got a kind of a oligopoly in a funny kind of way, right?
Okay, let's move on to our next past pick then. EssilorLuxottica, which was $100 US at the time, remember December of 2023, and now 150, almost 151, return of 51%, total return of 53%, so very well.
Yeah, so Luxottica, it's a combination. Essilor was the French company, and Luxottica was the Italian company, which you would think that would never work out, but it has. But Luxottica was the frame business, so they make Ray-Bans, Oakley is there, and Essilor made the lenses effectively. That was their technology. So these two companies came together. It's a great business because eyewear, one, people are using computers more and all that stuff, so people's eyes get worse faster, and so glasses and sunglasses and all that stuff have become sort of a fashion statement as well. So that's helping out a lot. And so I think that, and also with Luxottica, if you see Mark Zuckerberg, he's talked about Ray-Bans and how he wants to use them. So it's the deal with Luxottica that he's doing, right? And there was some talk at some point in time that he would probably want to make an equity investment in Luxottica. So there's lots of growth in this business that continues to grow. They have a huge retail franchise like Sunglass Hut they own. So they have all these kind of things that people don't know about, but they're all by them. And so the eyewear is, as people have gotten older, I get it, and they tend to use glasses, and unless you can go to
like a laser option.
Contacts or laser option, but the laser option doesn't work for everybody, right? So I think that it's a great growth business, I think, and so we really like it, and I think that it'll continue to grow, and I think that it's got a demographic play as well as kind of an annuity. If you wear glasses and you like them, you tend to continue to do that as well, right? You don't switch.
Got it. All right, we are going to take a quick break then. We'll be back with Paul Harris, Portfolio Manager at Harris Douglas Asset Management. He'll take your questions in a moment. Welcome back to Market Call. Let's go straight to your phone calls. Jim on the line from Kingston, Ontario. Hi, Jim.
Hello, Paul. I'm calling about Couche-Tard. In the last 11 months, the stock price has gone down about 18 to 20%, and I was wondering your thoughts on the company.
Great. Well, thanks for the call. Yeah, so we own Couche-Tard. We owned it for a long time. I think the difficulty has been with the story is one, sort of this idea that they wanted to initially buy 7-Eleven in Japan, which has kept put a lot of overhang on the stock because would have been a massive acquisition. Obviously, that's not going to go through, and I think people are wondering now, what's the next step, right? They've made a lot of acquisitions, they've integrated them very well, and where does the growth come from? So one, this is an incredibly well-run company, and when they make acquisitions, yes, the debt goes up and all those things, but they've been very good about bringing debt down and rationalizing the businesses and rationalizing supply chain. So they're very good at doing all this stuff. I think what they need to do is probably do an acquisition that's slightly smaller in the United States. And there are a couple of people they can buy, right? So I think that's what, and one of the things they actually even talked about with the 7-Eleven acquisition is just taking the US franchise from it. Right, yeah. So I think that there's a great opportunity, this great growth. I think they've got a lot of people worry about them with people are going to go to electric cars, and so but they have a lot of experimental work going on in Norway on using stations charging stations and stuff like that. So they are way ahead of the curve on a lot of these things. And even with COVID, they were way ahead of the curve on how they set up, how to deal with all retailing people. So it's a great business. We really like it. I think you should buy it here. I think that would be in a few years from now, it'll do very well for you.
Okay, let's go back to the phones. We have John on the line from Milford, Ontario. John, what's your question today for Paul?
My question is, first of all, I noticed a caller from Trenton saying that you never own the stocks that you recommended. I see all check marks by everything you recommended on your past picks. I'd say that first. Now, I'm thinking, I own Great-West Life at $33. I'd like your thoughts going forward on what you think it's going to do. Thank you very much. Bye.
Right. So I think the Great-West Life and even if you looked at Manulife, which we own both of them actually. So I think they've done well over the last little while because these guys on the insurance side were rates were very low and then rates started to go up, which helped them a lot because low rates on their side works. And I think the other thing with Great-West Life is they've kind of really worked on improving their U.S. business, which was I hate to say disaster, but felt like it was a disaster because that's where all their bad numbers came from. The Canadian business was very good. So I think they've done a good job with those two things. And, obviously this is owned by can't think of the name now. They're owned by a larger conglomerate, right? So I think that sometimes owning the pure play is better than owning power than doing this, right? So, but Great-West Life has, I think, like a lot of insurance companies, I think that they're going to do well. The stock market is up. They do well because of that. I think they're rationalizing some of their U.S. businesses, which help them. And I think their Canadian business continues to do well. So we own it, and we like it here, and we would continue to buy it.
Got it. All right, Paul, we are going to take a quick break on the show. Back with Paul Harris, portfolio manager at Harris Douglas Asset Management, in a moment. Stay tuned. Welcome back to Market Call. Thanks for joining us today. Let's go back to the phone lines. Dave on the line today from Edmonton. Hi, Dave.
Hi, I was calling about Microsoft because I can see that it's like almost at the bottom of its 1 year range and like $400. And I was just wondering if you think it's a good buy right now or why it's been going down.
So we've owned Microsoft for a long time. And I think part of it, like if you look at all those, what they call Magnificent Seven, with the exception of Meta, they're all actually down or at flat on the year so far. I think one of the issues that you're going to deal with this stuff is because of they've this idea of the AI and Microsoft's going to spend about $80 billion in capex. Although that's coming down, they're going to spend about $80 billion in capex, and I think that is going to hurt margins and probably hurt a lot of the free cash flow that they have over the next maybe next year or so. So that's one thing that's hurting the stock. And I think the other issue is with these companies, whether it's Google, whether it's Microsoft, whether it's Amazon even, is that when do they see some revenue growth from all the AI spend? And that's a very difficult thing. I think in Meta's case is you can see it, you can't see it, but you can see that how they can use it to sell more advertising. On Microsoft's case, it's much harder because Microsoft deals with big institutions, and so they are, their data is very differently capped, and they have to do all kinds of different things to start using AI effectively. And that's probably not going to happen First, it's going to happen in little chunks. It's not going to happen. Some companies, not like TD Bank's, not going to say, "Okay, I'm just going to go to use AI all through our business." They will do it, in certain areas and segments. So it's going to take a lot longer. But they are probably one of the best companies to be owning from the institutional side, right? They have that power that they bring to large institutions is very important. So I think Microsoft is a great story. I think you're not going to see the fruits of that probably till next year. Don't forget, June is their year end, so they're going into their next year in 3 months from now, 4 months from now. So I think that's when you're going to see a lot more of the value that they can bring to a lot of companies. But I think that, and the issue is that they have to spend this money to build out what they think is the necessary foundation to build better AI products, right?
And that takes time too.
It takes time. So I think it may move sideways from here or maybe down a little bit, but I think that at some point in time, I would look to buy it here, so.
Got it. All right, let's move on to Nazar, who's calling from Scarborough, Ontario. Nazar, what's your question today?
Hi, Mirella. Hi, Paul. May I have your thoughts on Enbridge, please? It has a handsome dividend yield of 6%. The stock has come down from a high of $65.50 to $60, as have the other pipeline stocks, such as Pembina Pipeline. Is the 10% tariff threat the reason? And is Enbridge a buy here at $60? Thanks for taking my call.
Right. So we own Enbridge. I think it's a buy here at these levels. I think Enbridge has had a very good year so far. It's up a lot over the year, 1 year time. So it's pulled back a little bit. I think that people are just worried about anything to do with tariffs in this country, right?
Of course.
Because it affects Canada substantially more than it would affect kind of the U.S. And so I think a lot of companies, whether it's oil, whether it's any manufacturing companies, are all going to be hurt by this. And I think, like I brought up at the beginning of the show, it's the unpredictability of it. So if somebody said, I'm going to put a 10% tariff on you or 15% tariff, you would, as a company, kind of deal with that. The currency would adjust for all these things. But generally, pipelines are not going to have to worry about all that stuff because they're not, there's a flow through that goes through, and they need this product, right? So I think they're safer than most places to deal with this stuff. But Enbridge has been a very good company. I would say one thing about kind of Enbridge and a lot of these pipeline companies, I think they found it very hard to do business in Canada. And if you looked at Enbridge, most of their purchases have been in the United States, and so they really think of themselves as not so much as a U.S. company, but I think that they just see doing business, doing deals and all that stuff is a lot easier in the United States than this country.
Is that because of the limited growth possibility in Canada?
Well, I think part of it is a really bad regulation, right? We just had very poor regulation from the Liberal government on this area. And so, when you have a company like Enbridge that doesn't want to do infrastructure projects in this country, and the company go on about this, why aren't you investing more? But if you make it so difficult to do that, then it becomes harder, right? So they're better off being in the United States, where it's a lot easier to do a lot of these infrastructure projects. So I think, and you've seen that with a lot of these companies, they just don't want to do those kind of big projects in this country anymore.
Got it. All right, let's move on to Kevin, who's calling from Kitchener, Ontario. Hi, Kevin, what's your question today?
Hi, guys. Paul, I was just wondering your thoughts on CP Rail for a long-term hold of about 15 plus years. Thanks very much.
Right. So, so one thing I think is that I don't own CP, I own CN, but I think that, and CP trades at about 23 times earnings. It trades at a premium to all the rest of the rail stocks as a general rule. I think that so people kind of have been worried about this kind of area too because of tariffs and stuff. But the rail business is a great business, right? Because it consolidated many years ago, and they sold off a lot of their non-core assets. Like a lot of these rail companies owned buildings and hotels and all these other things. So they've all sold those off, and they're pure rail businesses. What's great about CP, when they bought Kansas City, they actually became, and that's why CN maybe wanted to bid on it initially, is that it really has a franchise that goes from Canada all the way to Mexico, right? And so it's a beautiful thing from that perspective. You're not getting more rail lines, and it's much harder to put in. There's much better pricing because it's an oligopoly in many ways. So the rail business has become a really great business. I just think that it's trading at a premium to those businesses, and it did for a while because that putting those two things together made a lot of sense for CP, right? It did not make a lot of sense for CN. So CN trades at a much lower multiple. But either of those companies, I think it's worth owning for the long term. You'll do very well with them, right? So CN has a much higher dividend, about 2.3. CP has a dividend of less than 1%, I think. But saying all that, I think they're great business to own, right?
Okay, Kevin, I hope that answered your question. That is all the time we have for calls today, but don't go away. Our guest has their top picks. That's coming up. Welcome back to Market Call. Time now for top picks. So we will bring Paul Harris into a conversation. His first pick is Alphabet. You like Alphabet, even though it's a lot of money to dish out for people. Why do you like it?
Well, so obviously Alphabet or Google has the largest, the largest player in search, right? That's the first thing. Second thing is that it's not trading at a huge multiple, about 20 times, less than the market multiple. They have other businesses like YouTube, which is, I don't know, if you want to put up a house, you could probably do it on YouTube these days. So you know what I mean? So everybody goes to it. And they've not monetized that as much as you would think. So I think that's one thing. The other thing is that they have Waymo, which no one gives them credit for, which is their self-driving business, which has much more data than even Tesla does. So I think that that's one of the important things about that. And and digital advertising is probably a $400 billion business, $500 billion business. They own 30% of that, so they have 30% of the market share in that. So it's a continually growing. No one really puts ads in newspapers anymore and stuff like that. So the reality is that this is a great business. It continues to be a great business. I think you've seen some monetization on the Meta side with advertising, and people don't give Google enough credit for being able to do that as well. So I think that there's a lack of that aspect of it, and they're a big spender, obviously, because they're a cloud business on AI and all these other things. So I think it's a great story. It'll continue to be a great story. It gets tons of free cash flow. I have no debt. It's one of the best balance sheets around in the world, and like many of these tech companies. So I think that you can own a very good business that will continue to grow in double digits over the next several years. And I think that people are undervaluing that right now.
Yeah, it's at 181, 182 at this point.
Yeah.
You'd still buy in?
Oh, yeah, I think so.
Okay. Let's move on to your next pick, which is Novo Nordisk, which we talked about earlier.
Yeah, right. So Novo is a Danish company. You can buy it in New York. Obviously, it is their biggest drug it's fallen a lot, but their biggest drug is Ozempic and Wegovy, which are obesity drugs. So I originally bought the stock because they were the largest player. They dealt with obesity through. I lost my train of thought, but so I bought the drugs not because of this drug, to be honest with you, and this happened. But there's only two players, like I said, them and Eli Lilly. Their franchise, people forget the problem with obesity or overweight, which is a very large percentage of the North American population, even China actually has a very large overweight business problem, is that obesity or overweight causes a lot of chronic diseases, as we've seen that, so sleep apnea, heart disease, all these other things. And I think that what people are missing is that these drugs help bring down the risk of a lot of that stuff. And I think that is what's very key to even dealing with the health situation or the hospital costs in the United States and all stuff, is bringing down chronic disease. And so I think that's what we need to do, right? So I think that's why this company is going to benefit from that, especially on the obesity side. So I think that people are forgetting, like I said earlier on, there are other players coming, but these guys are way ahead of everybody else. The stock also fell because they were coming out with a new molecule that they said was going to, bring down weight by 25%. When they brought out when they announced the stuff, it said it brought down weight by 22%, and they dropped the stock by 15 or 20%, which is so crazy, right? So, so like I said, so to me, this is a great franchise. It's a great business, and the other thing is that it's the Novo Foundation owns a majority shares of this company, and they can't be taken over ever. So it's not like a public company in the sense that somebody could buy them out, and they have other businesses as well. So I think that's really important. But the obesity drug is their biggest business.
Interesting. All right, let's move on to your last pick here, MSCI Inc. Tell me about that.
So MSCI does MSCI World Index, all these different indexes, and they're really important because they're used by the asset management business. They're also used by a lot of alternative asset managers, and they bought some alternative asset managers. So they're not only use the indexes, but there's analytics around indexes. There's risk management around indexes. So once even though asset managers can't make up their own indexes, they have to use somebody. So this is one of the biggest players in that side. It's really an oligopoly. There's only three players.
I was going to say, are there other players?
Yeah, there's S&P 500, and there's FTSE, and then there's them, right? So there's really three players, and I think that, and once you the retention on your client retention is very high, close to 90%, because people don't change their indexes all the time. So there's a lot of other analytics that go with it. It's just not, I have the index, right? I'm just benching against this. It's the analytics that go around it, and you need the analytics to be able to do a better job of managing your portfolios on the risk management side, especially.
But very quickly, is there growth in that?
Yeah, there is, because there's constantly people, look at the ETF market that's grown so much. Private asset managers continue to grow. The one risk to the story, and I would say this, is that some asset managers have consolidated, so you don't need, if you got two of them together, you're just only buying one index, right? So that's hurt them a little bit. But overall, they've been able to do increasing prices on the stuff, not as quickly as they were previous years, but pricing has been able to go up. And I think that they moved into the alternative space as well. They bought a real estate company that does indexing, so and then they're going to do a bunch of other things. So there's really good growth in the business over a long term as these businesses grow, right?
Okay, so basically it's like a Netflix subscription. You pass it on to your brother and you both do the same thing.
Well,
and they got to learn how to control that.
Yeah, so that's a lot easier to control in that environment than the Netflix environment.
Sure it is. Okay. Well, we got to leave it there. Thank you very much for coming in. I'm sure we'll see you again soon. Let's take a look at the markets as we head to a break. Let's take a look at the TSX to start. We're at 25,231. So we're up today 84 points, climbing back from Friday's sort of dismal close, which was over 300, I think it was. Let's go on to the S&P 500 at 625 today, up 12 and a half. Now the NASDAQ 19,478, but down 48 points, just jumped right there. Taking a look at the Canadian dollar as well to see where we are up against the U.S. The Canadian dollar sitting at 70.32, so it's up just a fraction today over the American dollar, but we always appreciate it when it's up above 70 cents because it wasn't for so long. That's all the time we have for you on Market Call. Thanks very much for joining us today. I'll see you again tomorrow.